Alibaba, for years, that name was basically a synonym for China's tech boom, just unstoppable. But let's be real, the story lately, it's gotten way more complicated. This is a company at a huge crossroads, feeling the heat from every direction, and it's forcing them to make these massive, potentially game-changing bets on where they go from here.
So all that pressure, all that change, it brings us to the one question that really matters if you're looking at this stock. After getting absolutely hammered in the market, is this thing a once-in-a-generation buying opportunity just staring us in the face? Or is it a classic value trap, a falling giant that's just going to keep sucking in money and giving nothing back?
Okay, so today we're going to conduct a full investigation to figure that out. We are going to dissect the business, we're going to run the numbers, and we're going to assess what it's actually worth to come up with a final, definitive verdict. Let's do this.
All right, first things first, we have to understand what makes this company tick. What's at the core of the Alibaba empire? And more importantly, what major forces are pushing it forward and holding it back? So Alibaba is this absolutely sprawling ecosystem, right? But its heart, the main cash engine, is still e-commerce. You can see it right here. Taobao and Tmall make up about 45% of the revenue. That's the core. And this is the important part, the real story, the thing that's going to define its future is in those other slices, international commerce, and crucially, its massive bet on cloud intelligence. Those are the pieces we really need to keep an eye on.
So how did Alibaba get so dominant in the first place? Well, it's all about its moat. And what a moat it is. It's this incredible integrated ecosystem. Just think about it from a user's perspective. You shop on Taobao or Tmall, you pay seamlessly with Alipay, and your package gets delivered by their logistics arm, Cainiao. For over 900 million people, it's just easy. And that seamless experience, that is an advantage that is just unbelievably hard for any competitor to copy.
But that powerful moat is being tested like never before. The company is getting hit with two major headwinds. First, the competition at home is just brutal. We're talking about rivals like PDD and JD.com who are really squeezing their profits. And second, you've always got that shadow of regulatory uncertainty in China. The impact of all this? Well, you can see it right here. A jaw-dropping 71% drop in profit in a recent quarter. That's what happens when you're forced to spend a ton of money to fight these battles. Okay, a 71% profit drop is, well, it's alarming, to say the least. So for the next part of our investigation, we've got to follow the money. It's time to put Alibaba's financial health under the microscope.
All right, let's start with the top line, revenue growth. Now, it is still growing, which is good, but look at that number, just under 6%. I mean, this is not the Alibaba of old with that explosive hypergrowth we all remember. This is the pace of a mature giant that's in a real dogfight with its competitors. So yeah, the business is still getting bigger, but the days of easy, massive gains, those are long gone.
Okay, now for some good news. Let's look at the gross margin, over 40%. The easiest way to think about this is like the basic profit a store makes on an item before paying for rent or salaries. A number this high is really healthy. It tells us that Alibaba's core business, what it actually sells, is super profitable. It has serious pricing power, which is a huge strength.
And here's another key point, especially with all the turmoil. The company's foundation is solid. It has a pretty low debt-to-equity ratio. Now, this is super important because it means Alibaba isn't drowning in debt. It's not dangerously over-leveraged. It has the financial strength to ride out these tough times and, more importantly, to fund those big new bets it's making without being crushed by interest payments.
Okay, but here it is. This is the number that really freaked out the market. Negative free cash flow. We're talking about almost 22 billion RMB. Put simply, the company spent way more cash than it actually generated. Now on the surface, that looks like a five-alarm fire, right? It looks like the business is just bleeding cash. But we have to ask the most important question, why?
And here is the answer, straight from the CFO. This isn't the company falling apart. This is a choice. It's a deliberate, massive strategic pivot. That negative cash flow? It's happening because they are pouring billions. We're talking 120 billion RMB over the past year into building out their AI and cloud businesses. This isn't a mistake. It's a giant bet that the future of Alibaba isn't just about e-commerce, but about becoming the engine for a whole new era of tech.
Okay, so let's recap where we are. We've got a stable, profitable core business that is choosing to burn cash right now to invest heavily in its future. So the next logical question is, what's a fair price for all of that? What does the market think this company is actually worth today?
And this, right here, is the entire debate in a nutshell. You've got two camps. On one side, you have the bulls. They'll point to the valuation and say, look, a PE ratio around 22 is way cheaper than a US giant like Amazon. They believe you're getting a world-class company on sale. But then you have the bears. They'll look at that same discount and say, yeah, that's justified. They argue that the geopolitical risks with China and that brutal competition mean it deserves to be cheaper.
So what do the pros on Wall Street think? Well, if you average out their price targets, the consensus is about $203 a share. Now, depending on where the stock is when you're watching this, that number suggests there could be some pretty significant upside over the next 12 months, assuming they've got it right.
But there's one huge risk here that's pretty much out of Alibaba's hands. It's the big external threat. First, if the Chinese economy slows down in a major way, that's going to hit their main e-commerce business hard. And second, and this is critical for that big AI bet they're making, if the US puts more restrictions on selling advanced chips to China, that could seriously kneecap their ability to build out the tech they need. It's a huge what if.
All right, we've looked at the business, we've looked at the financials, we've looked at the valuation, we've seen the good, the bad, and the ugly. It's time to put all the pieces together and deliver the final verdict.
So, after all of that, it all boils down to this single question. Is Alibaba a buy, a hold, or a sell?
Our verdict, based on all the evidence we've just gone through, is a buy. Here's why. You have this incredibly strong cash cow core business, combined with a very aggressive and strategic pivot into AI, all at a price that's a clear discount to its global peers. It's a compelling opportunity for sure, even if it's going to be a bumpy ride. And to put a number on it, we're aligning with the Wall Street consensus. We recommend a BY with a 12-month price target of $203 per share.
So let's just boil this whole thing down. If you remember nothing else, remember this. The strongest reason to buy is the combo of that aggressive AI pivot and the discounted valuation. You're basically getting a front-row seat to a huge tech transformation at a reasonable price. Now, the biggest risk, the thing that could blow this whole thesis up, is that margin compression. If the competition just keeps eating away at their profits and that big AI bet doesn't start to pay off, then this whole thing falls apart.
Now look, maybe the volatility and the big pivot at Alibaba isn't for you, and that's fine. There are other ways to play this space. You've got PDD Holdings. That's the hypergrowth disruptor. All about value, all about speed. It's a higher risk, potentially higher reward bet. Then you've got JD.com. Think of them as the reliable, trusted retailer built on incredible logistics. That's a more stable, less flashy investment. 3 different companies, 3 very different stories. And that really leaves us with the one big lingering question. Will this massive and frankly painful investment in AI be the thing that transforms Alibaba? Can it actually shed its skin as just an e-commerce giant and reemerge as a totally new kind of global technology leader?
We're definitely going to find out over the next few quarters, that's for sure. Hey, what company should we break down next? Let us know down in the comments. And of course, don't forget to subscribe for more deep dives like this one.